Hi everyone, so I'm previewing what to look out for in the week ahead in financial markets, and I'm putting a particular emphasis on bank shares this week. Now you know what they say, give someone a gun, they'll rob a bank, but give someone a bank, they'll rob everyone.
Good afternoon, this is the Barrel Gang. Now if everybody will just take it easy, nobody will get hurt.
Well, investors in banks have not actually been doing quite as well as bank robbers in recent times. In fact, the shares have been serial underperformers really since the financial crisis, but alongside a bunch of other beaten up value stocks, the banks have picked up in interest in the last couple of weeks. Then there was a big decline when the Federal Reserve announced that interest rates would be stuck down near zero until 2022. So there's a lot going on with bank shares. I will talk about those and some highlights from the economic calendar in just a minute. Okay, so before I start looking at those bank shares, let's have a quick look at the economic calendar and some of the highlights there. So still prioritizing the most recent data because we're still trying to work out how quickly we recover from this pandemic. Now, consumer confidence from the Eurozone will be straight up, something to look for on Monday. That's expecting a decline in June. And then a similar picture emerging from other European, UK and the US in terms of the service sector from those PMIs data, because they're all looking like pretty much declines across the board in June. So that's a shame because obviously we want to see signs of a recovery. That was there in May, but it looks like it's petering out a little bit in June. It's only manufacturing in Germany that's maybe just staging a much slower, steadier recovery. We've got the RBNZ meeting on Wednesday, and then we have the German IFO expectations, GfK consumer confidence survey, and durable goods orders from the US. Obviously, a big one is always US GDP. This could be interesting potentially just because it's a second revision. So, okay, we're looking at a drop down from potentially from 5% in the last revision to 5.1%. But we've got more data about the end of the month when the pandemic really started kicking in. So maybe we actually see a bigger revision lower than we were expecting. That could be a risk-off type event. Last but not least, Japan CPI and US CPI, that's the core PCE that's watched by the Fed. Now, in the context of those PMIs, I did want to talk about one quick thing before I talk about those bank shares, which is that New York City is entering phase 2 of its reopening process on Monday. So why do I talk about New York? Well, obviously it's the financial capital of the world alongside London. And so there is an extra level of importance because of the financial aspect for financial markets, but also because New York was really hit. Again, like London, really hard hit by the pandemic. So the fact that they're pulling out and continuing this reopening process does somewhat offset the nerves that we were getting last week about some of the higher numbers in the likes of Texas and Florida. So that will be important to watch how that New York reopening progresses. And I think that could be a little bit boost for markets if that all goes ahead as planned. Okay, so what about these bank shares? Well, during the sell-off in March, the banks were some of the worst hit. Now that makes sense because these are cyclical shares. So that's companies that do well when the economy is doing well. Obviously, banks want to be lending when there is a desire from businesses and people to take out debt because they're feeling confident about the future. That clearly is not going to be the case when we're in the middle of a recession. So a recession is a bad time for banks. And so naturally you saw those bank shares really hard hit. But what's been more interesting recently is that with this mass grab for value companies, deep dive value companies, bankrupt companies in some cases, then actually banks have been pretty grabbed up and the share prices have been doing much better recently. Now we had a bit of an upset because in the last meeting, the Federal Reserve said that they would be keeping interest rates near zero until 2022. So obviously that's not demonstrating some huge confidence in an economic rebound. And it means that interest rates will be very compressed for banks to make money on that interest rate margin. So not such good fundamental news for banks. Now, what's particularly relevant for banks this week is that we have US bank stress test results. Okay, so The Federal Reserve have forced banks to do this ever since the Dodd-Frank Act came in not long after the financial crisis. So basically, there's a series of tests that the Fed make up against the banks to see how well they're faring. Obviously, it's been a bit more of a stressful time recently, so we want to see how well those banks are coping. If they're doing very badly, then obviously there's a risk that this economic crisis quickly turns into a financial crisis via the banks because people lose confidence in the banks. There is a bit of a kind of rigged element to these tests because obviously regulators don't want to scare everyone with how badly the banks are doing. I suspect they're actually not doing that badly, but from an investing standpoint, that tail risk is that they're doing very badly, and that's a risk to the economy and becomes a financial crisis. I think more likely is that for especially a lot of these smaller, more regional banks, and also for the big mega banks, the Fed is going to be very much less happy about them doing large-scale dividends and share buybacks. And so when you cut out those buybacks, cut out the dividends, the expected return on these shares, on these bank shares, is much lower. You're not going to get the capital appreciation because of the difficulty the economy is having. So this is potentially a big risk event for banks coming up. If they can weather it and the share prices hold up, that would be a good positive buy signal. If the shares really start falling off, then we know that, okay, banks are going back to their former lack of glory. All right, thank you very much for watching. That's all for this week ahead video. Make sure to subscribe on YouTube and Instagram, and you'll be able to make sure you don't miss the next video.